There are four main types of businesses: sole proprietorships, partnerships, corporations, and limited liability corporations. When a company is created, they decide what type of business that they are going to be when they are filling out their paperwork to become a business. Some businesses start as a sole proprietorship or a partnership and then become corporations. Some businesses purposely start as corporations. We also have that a sole proprietorship and a partnership can be a limited liability company. I'm going to talk about these just a little bit so you get an idea of what the different types of businesses are. When we are looking at information in our accounting classes, we are mostly focused on corporations. A lot of these things translate over to sole proprietorship and partnerships. Also, one of the main differences, one of the most significant differences between the three entities is in tax law. So, corporations, although also have to follow U.S. GAAP rules and different things. Okay, so a sole proprietorship is a single owner. This is the single most common business type in the United States, is a sole proprietorship, where a person has decided to start their own business. It is easy to set up. For $500 and a little bit of paperwork, anyone can start their own company as a sole proprietorship. And I'm going to say roughly $500. That's to get a tax identification code to file within your state, business entity documents, etc. Sole proprietorships, single owner, one person owns it. That owner is personally liable for the entire company. It's not a separate legal entity. And what this really means, this liability and the entity thing, is that if someone sues a sole proprietorship, the owner is not protected. And that means that in a lawsuit, their personal assets can be attacked as part of the lawsuit. Okay. Where in a corporation, the owner is protected, and in a lawsuit, the personal assets of a corporation cannot be attacked. Okay. A partnership has two or more people. Some people, when they think of partnership, they think just two people. Well, I've done taxes for partnerships that have had more than 100 partners. Usually what is decided when you're setting up a partnership is what percentage of ownership each partner is. The percentage of ownership dictated in the contract decides how much of the income comes over to the individual. Partners, there's unlimited liability, just like sole proprietorship, where the owner's personal assets can be impacted in a lawsuit or a bankruptcy. Okay. In corporations, you can have one or more owner. They're called shareholders. You usually get owners by selling stock or shares of ownership. And there are multiple different kinds of stock. We're mostly going to talk about corporate stock, which is called common stock or capital stock. And this is stock that is sold on the stock exchange. Okay. Benefits of a corporation is that they have limited liability. The owners are not personally held responsible for debt. Corporations are separate entities. They are defined as people by the U.S. court system, and the business life is indefinite. And then a limited liability corporation, what this does is this creates a limited liability so the owners are not personally liable for the debts of the company. For example, a single person, such as a sole proprietorship, can file, it's called Articles of Incorporation, to become a limited liability company. And then they can operate as a sole proprietorship, but then they have that protection against their personal assets. Okay. As I said, most of the things that we focus on, we're focusing at the corporate level, because all businesses have to follow the same thing as the corporations do as far as financial accounting rules and regulations, and then corporations have a few extra rules that they also have to follow. So now we're going to talk about the different types of accounts. Okay, so here we have in front of us the accounting equation. And the accounting equation is that assets equal liabilities plus equity. So we have three main types of accounts: assets, liabilities, and equity accounts. And we're going to talk about each one of those individually. So asset accounts. Asset accounts are things that the company owns, things that have future benefit to the company, and things that the company is using in their daily operations. So assets include supplies, cash, land, buildings, equipment, and then the accounts receivable and notes receivable. So what accounts receivable and notes receivable are is when other people owe us money. And then we have prepaid accounts. What a prepaid account is when we have paid ahead for a bill or a service, such as paying rent or insurance several months in advance. Okay, assets, as I said, economic resources owned by the business that are expected to benefit future operations. Okay. The next type of account is a liability account. A liability is when we owe money to someone else. So we owe our employees that work for us. We owe the bank when we borrow money. So we'll talk a little bit about these. Accounts payable, this is when we owe someone money, like a supplier. So we've bought supplies and we bought them on credit and we have to pay for them eventually. Accrued liabilities are liabilities that are not paid yet. So this is like salary, where if we pay salary once a month, we accrue that amount throughout the month, and then we pay it out like on the first day of the month. Notes payable is when we owe somebody money for a loan, like a bank. And then unearned revenue looks at when we've been prepaid for a product or service. So a person has paid us in full in anticipation for a product or service and we have not delivered it yet. That's called a liability because we owe them the product or service still. Okay, so liabilities said, obligations or debts, we owe money to another person in some way, shape, or form. We have to pay these people. And then equity accounts. Equity are owners' claims on the company. Okay, so common stock, capital stock, dividends, expenses, and revenues are all part of our equity accounts. Our owner's equity is the owner's claim on the assets of the business. For example, if we've sold $100 worth of stock, then we're going to have common stock of $100. We have an owner that has given us $100 for that stock. Okay. This also includes investments we've made into the business and the amount of income that we've earned minus any dividends that we've paid out. So I already talked about the accounting equation, which is assets equal liabilities plus owner's equity. Okay, or the equity accounts. This is also the same equation as a balance sheet, which is one of the financial statements that we will be talking about in a little bit. For our accounting records to be true and complete, this accounting equation must be true. The math must be true. When we add up all of our asset accounts, all of our liability accounts, and all of our equity accounts, the equation must be assets equals liabilities plus equity. If this is not true, then something is wrong in our accounting records that needs to be fixed. We can expand the accounting equation by expanding the equity section. So our equity section includes common stock, dividends, revenues, and expenses. And revenues and expenses goes into our accounting equation in what is called retained earnings. And we're going to look at retained earnings a little bit more deeply when we make financial statements. Okay, for example, here we have these accounting equation examples, and if we were to go line by line, we would want to know what is the number that we need to put in order to make this accounting equation true. For example, here we have $20,000 in liabilities and $45,000 in equity, but the assets section is blank. And so we know that assets must equal liabilities plus equity. So in this case, we can add together equity and liabilities and get $65,000, which would be the assets. In this section, we have assets and liabilities. Because we know that assets equals liabilities plus equity, we know that the missing equity amount is the difference between liabilities and assets. So we can subtract this $34,000 from $100,000. We would get $66,000, which is the equity amount. I encourage you to practice with these. Okay. In this example, and we're going to do some more examples in an Excel spreadsheet later, we will be doing a lot of Excel work throughout the semester, so I encourage you to get comfortable with Excel and start practicing in Excel because we will be using it every single week. So in this example, we have our assets are $300,000, our equity is $100,000. And during the year, assets increase $80,000 and liabilities increase $50,000. So what is the equity at the end of the year? Okay, so if we're looking at, so we have $300,000. And I apologize for really bad penmanship, equals our liabilities, which we don't know, plus 100,000. So it's fairly easy to do the math right here. And so we now know that our beginning of the year liabilities are 200,000. Because our accounting equation has to equal. Okay, so we have during the year assets increase 80,000. Okay, so 80,000 plus 300,000 equals 380,000. And liabilities increase 250,000. So we had 200,000 at the beginning of the year. If they increased 50,000, we now have 250,000. And we are looking for this number here. So this is our X. Okay, so our end of the year equity would be 380,000 minus 250,000, or 130,000. Okay, let's look at another example really quick. So here we have assets equal to 123,000 at the beginning of the year. see if I can. Yep. So 123,000. It would be helpful if I could write on this screen instead of using the mouse. Equal 47,000, and then we want to know what are the total equity. So our X, what is equity? So we would take 123,000 minus 47,000 and get our equity. Okay. So as I said, we're going to do some more examples. We'll come back in the next video and start talking about recording our accounting records.